Hi, this is Mihi Jun from the University of American Studies. Feels like it's been a while since I greeted you on a weekend broadcast. The man who comes to mind on weekends, Chief Executive Officer Kim In-jung and Ji-hoon Mi have visited us. Hello, Chief Executive Officer.
Hello, Chief Executive Officer. Nice to meet you. Yes.
Nice to meet you. Well, Ji-hoon Mi has visited us. It's a bit embarrassing to introduce you like this now. You upload Ji-hoon Mi's videos twice a week. Rather than being a visitor, you're now here as one of the hosts.
I'm not a host. I just appear when you're not around, and honestly, I feel more comfortable meeting together like this, rather than doing it alone.
Yeah, that's a relief. I guess I'm still a bit useful.
It's been really comfortable, and you've organized and led things so well that I'm living very comfortably.
Thank you for saying that. Actually, it's been a really long time since we've sat together in front of the camera, but in the meantime, you've been consistently uploading videos, and the video you uploaded a few days ago was what people call a big hit. So, you uploaded a video that has become really popular, almost reaching 50,000 views. Congratulations. It's not easy for me to get that many clicks either.
I was really surprised. I thought maybe at most about 10,000 people or 10,000 views would watch it, but I was really surprised. So it made me think about what kind of content actually works.
I hope I can appear in more hit videos like this in the future. We haven't been able to run the United States Stock Elementary School program for the past few weeks. It seems like it's been nearly a month since we last met. I'm sure a lot has changed with ChoiceTark and everything else since then. It's a constantly evolving program. During the time we weren't able to greet each other, if there are upgrades, could you tell us about them?
Yes, we've launched a really important service. Now, during the last quarter's earnings season, we announced the launch of Edgut Flash, a service similar to Apple News. For those of you who have set up your watch list in our Choice Talk app, you're probably receiving a flood of notifications as soon as earnings are released, allowing you to instantly access very useful content. Ahead of this quarter's earnings season, we've opened this up and worked hard to develop this service accordingly. Finally, we launched it last week and this Monday, so the service is called Why Did It Rise? What investors are most curious about is when a stock they're interested in or holding suddenly drops or rises sharply, they search for news articles and try to find the reason, but often it's not easy to find the answer right away. People get frustrated and anxious when they need information to decide but can't find any, making judgment difficult. This has happened often. That's why this time we've included not only why did it go up in our brand and service called Why Did It Go Up, but also Why Did It Go Down? So the standard is when the price changes by more than plus or minus 5%, it detects it and collects information on why it went up or why it went down. We gather all information and if justified, send notifications as needed. Some of you who have set up watch lists have probably already received this push notification, so some of you might have wondered, what is this? So this is a service that tells you the reasons why something went up or down. So now we've set it up to work properly and we're currently working on adding various sources to it. So probably by the next quarter, we should be able to cover why most stocks have gone up. I think we'll be able to find almost all the information that's available in the market. Right now, in terms of information coverage, I think we're at about 20% or 30% based on my personal goals. As the sources of information increase, I think we'll be able to bring in information from a much wider range and quickly find the causes or reasons behind things. Let me briefly show you our actual service screen and explain how you can design it.
Yes, that's good.
Yes, thank you. You see the screen, right? Yes, I see it. Now, on this screen, this morning, right now in the pre-market, IonQ is soaring by 12.7% in the pre-market. Usually when something jumps like this, you get curious, right? Why did it go up? Yes, if you look below, right under the overview, it shows up here. Now it says the stock price has jumped 10% and it gives you the information. So if you don't see this screen, it means that content isn't available. So I'll try clicking here and take a look. When I click it, a pop-up appears and I'll read it for you. Now let me explain why IonQ is up 12% in the pre-market. The Wall Street Journal reported that the Trump administration is pushing a plan to directly acquire stakes in quantum computing companies. At least $10 million in federal funding is being considered in exchange for acquiring stakes with companies like IonQ, Rigetti Computing, D-Wave, and Quantum as potential candidates. This aligns with the Trump administration's policy of equity-based support as the government invests in strategic industries while also expressing its intention to share in the profits. That's why it's surging right now. That's the explanation being given. So, now it's easy to understand right away. So when this kind of information comes up, if you mark the heart icon as a favorite on this, whenever there is news about your favorite stocks, we will deliver it right to your hands. Clicking it takes you straight to this page to view immediately. Next, if you look at the bottom here, you'll see a link that says, "Why did this stock go up?" If you click on it, we're providing the timeline for all stocks today, not just for a specific one, so you can see what's coming out right now. For example, as of 8:20, and currently it's 8:28 Korean time. So right now in the pre-market, Brand Financial is up 5.9% after announcing its earnings, and it's showing you this information. For West Pharmaceutical, if you click on it like this, it's up 6.5% after raising its earnings guidance. It's already showing you all this information after the articles have been written. It went up 6.5%, but if you look now, it's currently rising even more, up to 7.2%. So if you look at these parts, you can get information a bit faster. You shouldn't do this on the web. You have to download the app to receive push notifications, and when you install the app, you must allow push notifications. Don't worry, we don't send marketing messages, so please make sure to allow notifications. You need to approve this to receive the information, so it would be great if you could approve it. So what's the basis for this? There are two lines below, and the first line is the summary we explained earlier. If you look below, there's content like this. If you click on it, this content is actually explaining the full article. In this article, we found the source and summarized it for you like this. So we provide both the full original article and a basic summary of the source together. So we're currently in the process of continuously expanding these information sources that we mentioned at the beginning. So probably next quarter's performance in the next season will be much more. Why isn't mine coming up? But as those issues are being resolved quite a lot, within the range where artificial intelligence can gather information, it can likely do almost everything and may still advance even without it. There are definitely such stocks too. Some stocks go up for no reason, and some break important support or resistance lines based on trends or technical analysis, but those things don't come out in articles, so those might not be included. But for the general information available in the market, we are internally aiming to reach that level as much as possible, so I think it would be good if you proceed like this. Next, the way to set it up in the app is, if you look at the top here, you'll see these three lines. When it first came out, we called it the hamburger menu, but it's also called the three-line Adidas menu. If you look at the name here, there's a menu called Settings next to it. Click on this Settings menu. It's at the top. Here you can turn push notifications on or off. So here you might wonder, why did this stock go up? This section has just been added so you can turn it on or off like this. Here, by default, it's set to only receive the ones you've marked as favorites. But if you want to know about all the stocks that are surging or plunging, even if you're not interested in them, you can just use this toggle. Change it from favorites to all to get everything, or keep it on favorites to receive only those.
Then it will upload one every minute.
So that's not the case. We checked, and it's because it has to move more than 5% first.
That
Since none of the stocks below that come out, Even though the earnings season hasn't fully started yet, there are about 50 cases a day. Even when it's full earnings season, I think it'll be between 100 and 150 cases. Instead, if you want to see a variety of information about which stocks are really popping, you can select all. If that's too much for you, you can just choose the ones you're interested in. If you look at the bottom here, you can also set the time you want to receive notifications. So if you don't want to receive notifications at night, you can set the time range, and after that, you won't get any push notifications at all. If you set it up that way, even if you turn on push notifications later, they won't come in during those hours. So personally, I just choose to receive all notifications, and then I set my phone to sleep mode so that even if notifications come in, they don't make any sound. It's better to set it up that way so you can check everything at once in the morning. I hope you'll try using this feature during this earnings season and that it helps you better understand the changes in those stocks and the reasons behind them. This was the biggest upgrade news for the Choice Stock app.
This is really amazing. This is just a side note from me. Last week, on Thursday and Friday, there was a sports day for the kids over 2 days. So I spent the whole day cheering at the sports day. And then in the evening, I bought dinner for the kids to thank them for their hard work. Also, my daughter's birthday happened to be on the same day, so I didn't really have much time all day. I also took a break from YouTube, and then there's the Miji One membership. Normally, I upload at least 7 or 8 articles a day, even on a slow day. That day, I think I uploaded 1 or 2 in the morning and 1 in the evening, so about 2 or 3 in total. So complaints started coming in right away. People were asking, what's going on? Why aren't the news updates coming quickly? Actually, it was the first time this happened in over 2 years of running it, and I was really surprised by how quickly people reacted. But for those of you who need news updates right away, please don't rely on the unpaid membership. It would be really great if you could use Choice Stake. Now, when Edgar Flash and Why Did It Go Up are combined, now, Edgar Flash needs to have a notice, so only major news like earnings or mergers and acquisitions that come into Edgar are reported. Instead, whenever there's a price change of more than 5%, artificial intelligence immediately writes a report by finding related news about why it went up. I think this is probably the fastest way to catch the overall market trends or changes in the stocks I'm interested in. From what I see, there are several media outlets in the United States, and right now the fastest ones are CNBC and Yahoo Finance, but at this rate, they might go out of business.
In terms of speed, we've confirmed that we're faster. We've already confirmed that our push service is much faster. So even now, there might be cases where other places have information, but we still don't. The information sources I mentioned earlier, we've finished those processes now, and we're in the process of expanding them. Once we've expanded everything, I think we'll be able to cover almost all the information. We're planning to keep expanding our sources with the goal of achieving that by next quarter.
Anyway, when I see Choice Direct developing, I feel like I need to hurry up and get it listed so I can buy some stocks. All right, now it's time to officially start the United States Stock Elementary School session. It's been such a long time since we've come back to class, I feel like we've forgotten a bit. About a month ago in our last broadcast, we studied valuation. When we talk about valuation, we usually think of PER, but in today's lecture, we'll be mixing growth rate into valuation and introducing a method to measure the growth rate and valuation that we care about. So could you please give us an introduction about this part?
Yes, we usually use PER for valuation, but PER is a static concept. Since it doesn't really reflect future growth rates, there have been some limitations when evaluating growth stocks. So this week I'll talk about the PE ratio, which is basically a PAR that takes growth rate into account. Next week we'll discuss growth stocks. In other words, PEG is for growth stocks. This is an indicator that Peter Lynch, one of the great investors, used a lot. And next week I'll introduce another great investor, Benjamin Graham. So, some people think Benjamin Graham only invested based on net working capital, or that he only invested in cigar butt type stocks with almost no cash. But actually, if you look at his book Security Analysis, there's a valuation formula related to growth stocks by Benjamin Graham. So I think he's pretty much the only one who actually provided a formula for valuing growth stocks. Most great investors talk about valuation in a very vague way, and there are hardly any who actually organized it into a formula. But Mr. Graham was someone who organized things clearly with numbers, so he was really great for giving us a framework to work with, and he did that decades ago. So I think if Mr. Graham were alive today, he would have built a solid conceptual framework and theoretical system for valuing growth stocks and similar investments. It's really a shame. Even back then, when there were only 3 lines on the income statement, he was already thinking about how to value growth stocks. So I'm sure he would have done the same today. So next week, I'll prepare Benjamin Graham's method for evaluating growth stocks. And today, I'll cover Peter Lynch's PEG valuation method. Yes?
I don't think the viewers of this show will be too disappointed. That's because we have Mr. Kim In-jong with us.
I'm embarrassed.
Please feel the pressure and share what you've prepared for today. Yes.
Then I'll go ahead and start with what I've prepared for today. It's been a while since we've had the United States Stock Elementary School, so this week let's take a look together at how to evaluate growth stocks using the PEG ratio. You can see the screen now, right? The textbook.
Yes, I can see it well, yes.
Alright, so first I'm going to start with a question. When we usually talk about valuation methods, we typically use PR for valuation. So if company A has a PR of 35 and company B has a PR of 15, just by looking at it simply, you might think that company B is undervalued because its PR is lower, so B is more attractive. Now let's say the expected net growth rate after 1 year is 70% for company A and 15% for company B. Then is company A really more attractive, or is company B more attractive? This is what we need to determine. Usually we use an indicator called PEG to compare which one is cheaper relative to the growth rate. But you probably haven't really thought deeply about why that is. We just understand that if the PEG is below a certain number, it's considered cheap. But why is a high PEG or high earnings per share growth rate actually good? Since you might not know about these parts, I'll explain a few of them with some numbers this time. Company A, as I mentioned earlier, has a PER of 35 and an earnings growth rate of 70%. The PEG ratio is calculated by dividing the PER by the earnings growth rate, so it's 35 divided by 70. So what I really want to say in this session is, if the earnings growth rate is 70%, it's usually 0.7 as a decimal, right? So it's 0.7, and generally when you divide by a percentage, you should divide by 0.7. But when you calculate the PEG, you have to use the number as it is. Some people divide 35 by 0.7 and comment, the PEG looks strange. People do this. It should definitely be in elementary school. If it's not, then I must not be an elementary school student anymore. When I first learned about the PEG ratio, I thought it was a percentage and tried calculating 35 divided by 0.7, but kept getting the numbers wrong. Everyone starts out that way, so let me tell you, just enter the percentage as it is. And so you just compare it like that. You take out the 35 times, remove the percent sign, and just compare using the numbers themselves. Next, company B. Since it's 10% of 15 times 10 divided by 15 gives a PEG of 0.5 times, while the other is 1.5 times. So in reality, you have to compare all growth stocks using this. For American companies, they usually check the PE ratio first, then consider the PG ratio, which factors in earnings growth. You need to compare both sides to make a proper judgment about growth stocks. That's how you should look at it. If this is 0.5 times and the other is 1.5 times, the lower one is cheaper, so company A is cheaper and more attractive. Then my question is, why is that? Is that really the case? So why is it like that? Then, if I show you the explanation below, I wrote here how this company's PAR changes. A company with a 70% profit growth rate will have its PR drop from 35 times to 20.5 times after 1 year. So, how do you calculate this? Since the current value is near 70%, you add 1 plus 0.7. This is done as a percentage. By doing this, you can calculate how much the PAR drops by this ratio. It becomes 20.5 times, and after 2 years, it increases by 70% again on 20.5 times. That's how fast the PER drops. If the stock price stays the same, the PER will be 12 after 2 years. For the one at 1.5 times, it becomes 13.6 after a year. And after 2 years, it becomes 12.3 times. Then if you compare their PERs after 2 years, which one is cheaper? Even just looking at the PER, A becomes cheaper. What do you think will happen if this goes on for 3 years? If company A's third-year profit growth is 30% instead of 70% compared to company B's 10% A's, PAR will fall much more. So after 2 or 3 years, since company A's PAR is lower, it means that A is gradually being valued more. So the very concept of a peg of 0.5 means the growth rate is high. And when the growth rate is high, the PER drops much faster. So you can say that company A is relatively cheap even in terms of PER. So I think it would be good if you understand the concept this way. Thank you. Now, if I organize the formulas a bit on how to calculate PR and PEG, some websites write it as price earnings to growth ratio. It means the same thing. So it's the same thing in terms of the PEG ratio. It's in the form of dividing PER by G. Then, which PER do we use? The original formula uses the trailing PER. We use the PR, which compares the stock price to total net profits from the last 4 quarters. Next, the earnings per share growth rate that Peter Lynch originally talks about isn't just for 1 year. He actually says to use the average annual earnings per share growth rate for the next 5 to 7 years. Here, we face a problem. How do we calculate the average annual earnings per share growth rate for the next 5 to 7 years? This is the real challenge. And even if you go to consensus sites or similar places, at most they show you 5 years and sometimes as little as 3 years. But then you start to face real issues like how do you secure data for 5 to 7 years and how can you guarantee that it's accurate? So when you actually use this in practice, what we often do as an alternative is to compare next year's earnings per share growth rate with the PER. And we usually create a pack to display this. It's the same on the current sites, but even when displaying this, the value of the pack can fluctuate a lot depending on which PR or earnings per share growth rate you use. So when you look at this pack indicator, you shouldn't just look at the current pack that's shown. You need to check which base year this pack is calculated from, and also see how it changes if you calculate it with the next year. Only then can you make a much more accurate and reliable judgment. Let me explain that part a bit more clearly for you. The company is called AMD and its current PER is 136 times. And the forward PER value, that's the expected PER itself, is based on the sum of the most recent 4 quarters, which is the trailing PER, calculated using the market capitalization. Forward PR uses expected net profit for calculation. So when we calculated the PEG earlier, for example, when calculating the PEG with the PER, and when you compare the earnings per share growth rate and the PER, the value of the PEG will be completely different depending on whether you put 136 in the numerator or 59.1. So when you see the PEG value listed on a website, you need to check what standard they use before making a judgment. If you just see, oh, the PEG is 0.4 here, it must be really cheap, and judge it like that, you could get into big trouble. So you should always calculate and check the PEG for the base year and the following year. That's the right way to do it. Let me tell you that. So on the right side here, in the end, this is the data value from our choice stock website. The expected earnings per share and year-over-year growth rate are shown here. 137%, then 69%. If I show you how this is calculated and how the PEG is determined, there are actually about 3 ways to calculate it. 1.97 right now. There's one calculated as 1.97 here. And then you can also calculate one as 0.99, or you can calculate one as 0.85. Let's say one site lists the peg as 0.85, while another lists it as 1.97. Then, even with the same company and growth rate, opinions on whether it's cheap or expensive can differ. We typically use 1 as the benchmark. If it goes over 1, we usually say it's a bit overvalued. If you look at it this way, it seems a bit overvalued, but if you look at it that way, it doesn't seem overvalued yet. But actually, we're talking about the same indicator right now. And that's why it's very important to always check things like the base year or what growth rate is being applied when you look at valuation indicators. So what's the best way to do it? All right, let me give you a tip. Here, you can see the projections for December 2025. The current date is October 23, 2025, which is the day we're filming. So it's the end of October. So if you look only at the stock market itself, I mean just the market itself, most companies' earnings consensus targets are already set for 2026. So the outlook has already shifted to that year. Because 2025 has already been revealed and is pretty much confirmed, that's the situation we're in. So the concept of power in front of us is also based on the sum of the most recent 4 quarters, so that's already confirmed too. Then, with this one, it's correct to compare this one with that one. This is called a heterogrowth material, and the pegs of 136 and 137 face each other, so only one is correct. So what value do you get? It's about 0.99, meaning it's a reasonable price. If, using an example, if you calculate next year's pattern, you get 1.97. The PER is 136. Since this year's growth rate is already finished, you have to use next year's. Next year's is 69%, so if you divide 136 by 69%, you get 1.97. It's expensive, so you don't buy it again. It's important to always align the reference point when dividing above and below this standard point. Since PR is based on the sum of the most recent 4 quarters, when it moves into the next year, personally, I don't think that's right. So you should look at the most recent year's data. Currently, since the market is in the 4th quarter, everything has already shifted. Then you should compare the PER with this as well. At the moment, I think this is the most reasonable indicator for looking at the P-edge. Then the calculation of that indicator for 26 years, I think this 0.85, which is 59 times 2 divided by 69 times 2, is the PEGI value that best explains AMD right now. So I think it's reasonable to say that AMD's corporate value is somewhere in the range where the peg is between 0.85 and 1. So I think it would be good to consider where to set this peg when you do your calculations. So, for those of you who are watching Mijuchu for the first time and are doing the calculations, since this PER is already fixed, it's best to use either this one or the previous year's figure. If it's January, then it's right to use this one, but if some time has passed, then it's correct to move on to the next year's figure. Then use this one, so you compare this with this, and then this with this, like that. By calculating the peg on an annual basis like this, you can analyze the peg indicator much more reasonably. I can summarize it for you like this. Then now, let me summarize 1 or 2 more things for you, and then I'll explain using a real example from a website. This peg ratio is usually what we call 1 times 1 times. This means the PER equals the earnings per share growth rate. So if earnings per share is expected to grow 50% annually for 3 years, the PER can be about 50 times. That's the point. So we consider this to be reasonable. Peter Lynch said that if this is 0.5 or lower, just don't be afraid and buy it because it's very undervalued. That's what people usually say. If it goes over 1.5, it's considered overvalued, so be careful. Usually people tend to buy within this range. So it's really important to look at the PEG ratio in that way for about 2 years, calculate it, and see where the real peg is before making a decision. I mentioned a similar chart last time, but this time I changed it to use the PEG ratio. Then if you look here now, the screen where the picture is being drawn in the middle like this graph is the appropriate PR for a proper company, and this appropriate PR is ultimately equal to the earnings per share growth rate. The multiple will likely be set similarly, so if earnings per share grows 25% per year on average, then you can think that giving this company about a 25 times multiple is appropriate, but the actual PR stock price is much. If the growth rate increases, it goes much higher, or if not, it drops below 2. That's how it works. So when the peg is higher than this growth rate, it becomes above 1, and below this, it becomes below 1. So it's basically best to buy when it's below this level and to sell when it goes significantly above it. That's the basic way to use the peg ratio. Next, I'll move to our website and give you a bit more explanation about this part. Yes? Since we need to look at a hot growth rate to match well with PEG, I chose this company. Let's look at some valuation indicators. When you view valuation this way, we've included this company in our portfolio only once. And that's where we are right now. If you look at it, it's been in a very overvalued range for a while, so there hasn't been a single chance to buy. If you look at it recently, this is the point where people have just started to come in. That's right. So in terms of this concept, a buy signal has recently appeared in the trading signals, and for the first time recently, a buy signal has come out. Right, yes, currently it's down by about 6%. Of course, if the supply and demand turns, it will probably cut its losses and get out. But anyway, in terms of price, it's starting to enter at a more comfortable price now. If you look below, in the overview, you'll see an indicator called PEG. It's listed there. If you scroll down to the bottom, you'll see peer and peg listed here. So if you just look at the peg, you might think, oh, it's 0.54 times, isn't that cheap? Couldn't it go up 2 more times? That's how you might think about it. That's why I said it's better to calculate these two together. This 0.5 comes from 350%. If you divide 350% by 189, you get about half the price. If you move on to next year, the growth rate is 33% this year and next. So the company is expected to grow about 33% annually for the next 2 to 3 years. Then you wonder, does that mean it only gives you 33 times? That's 33 times and 33%. If you calculate it as forward PE, you get almost 3 times in a sideways market. It was 0.5, but after December 30th, sites like Seeking Alpha will likely show the peg jumping from 0 point something to 2 or 3 times higher. Then how are we supposed to judge this? Yesterday it was considered undervalued, but today it's overvalued. What are we supposed to do? These kinds of things are one of the difficulties when using the PEGI ratio. So these parts you have to make a judgment about. Previously, it was viewed annually. Another thing is, I always say it would be good if you could take a look at the quant valuation we created. Even if the stock price falls, the fair value doesn't decrease the same way when we calculate it. For each company later on, we'll also have time to briefly cover valuation methods in our United States Stock Beginner series. There are companies where PER fits well, some where price to sales ratio or price to cash flow ratio fits well, and others where enterprise value or earnings before interest, taxes, depreciation, and amortization fits well. It's all different for each company. The type depends on where the company is in its growth stage, so you actually need to determine the valuation method based on that. But even so, when it comes to technology, I checked what kind of valuation is currently applied on our site, and right now it's using the price to sales ratio. It's using the price to sales ratio at the moment. The company's valuation shifts greatly based on its sales growth rate. So here, I'll try drawing a graph here. The kind of graph I'm going to draw is our fair stock price is defined as follows. Right now, you see how it's kind of like this jumping up in a stair-step pattern. That's because of the earnings announcements. Earnings are announced quarterly, so movement follows that pattern, but monthly events can shorten the intervals. We mentioned that we'll try to show you our expected projections in the future, and once that feature is added, we'll introduce it to you again. Adding this feature isn't an easy task. That's because creating valuations is an extremely difficult task, so we're still thinking a lot about that part. First, I'll try to draw this company's value as a curve, not a straight line, but as a curve. The reason I'm drawing it as a curve is because of something. Suppose the company's profit this year is $1 billion, but it doesn't earn this amount all at once at year's end, right? Daily profits steadily add up, eventually reaching $1 billion. Actually, it's supposed to be a curve when it comes to the increase in a company's value, but right now they're drawing it as a straight line. So we're also trying to change all of this to curves. We're going to change it to curves and set the projections. Let me try changing what's drawn at the top here into a curve, like this, a curve. It'll be drawn like this. The curve at the top will look like this. Then if I try drawing the lower curve, here's what happens. Like this. Down here, like this, there's a step in the shaded area. Like this. Actually, right now, it should be drawn like this. That's how it's supposed to be. Next, this part is called the upper section. The dotted line section is highly overvalued, and I'll discuss that upper part as well. I'm not very good at drawing, but I'll try to draw it. This part here is the dotted line, and this represents the highly overvalued area. Well, then the highly overvalued area is drawn like this, and it will probably grow in this way. Yes, when it's drawn like this, it really changes your perspective a lot. That's right. Up to this point, it was highly overvalued, and these were the kinds of lines. But after this point, what's going to happen to this company's value? I mentioned that I'm using the price to sales ratio, right? So because this is the price to sales ratio, the valuation increases in line with the sales growth rate. But for this valuation, sales are expected to grow by 120% this year. And as far as I know, for next year and the year after, I wrote down the numbers. This company will see about 28%, yes, that's right, about 28% average annual sales growth. What that means is based on the current standards, the fair price at this point in time, this part, which is called $112, after 1 year, not after 1 year, but right now it's set up for 6 months. It's going to increase a lot more than this. I've already calculated everything and brought it, so you'll see the amount after it goes up. Based on May next year, this company comes out to about $183. Yes, that's right, and it's not even an inflated fair price. Then I'll continue drawing the graph from here. If I keep drawing the graph, what happens is, here in 2020, that 6 years, May 2026, this part will be added later. So when it reaches a certain point, it'll be $180. So it'll be about here. I think this point will probably be $180. Then this blue line will go like this and reach here, and the bottom will reach here like this. And then the value at the very top from earlier too. Yes. Now this means that it goes up like this at this speed. Then the stock price is stopped here right now. Yes, it's stopped here. Yes, it's currently stopped here. But actually, if you compare this point to May next year, it's even lower than the appropriate price. Right. So the current price is recorded as an expensive price. And that's why I keep saying that when I do valuation, we need to talk about what standard we're using. The fair price now is $120 based on current standards and earnings. But for May 2026, it's $183. Some believe $183 is fair, and they're right too. So is $183 or $122 correct? Both are. That's why you need to clarify the standard by stating, I'm evaluating this over a specific number of years. So if investors think the fair price is $183, if the price drops just a little from this point, it actually enters an undervalued range compared to the fair price. Then from here until May next year, expected return is the percent gain when it hits 183. So we've researched this area that I just mentioned. What I'm trying to show you is our method, which I drew by hand. Since we need to have all the estimates for various valuation methods and the corresponding data for each item, There are companies that don't have that data. So there's still a lot of debate about how to estimate for those companies that lack the data. Anyway, this part is definitely. I promise our members that ChoiceTac will not stop. If we present this form early, it may seem overvalued, leading you to ask, why buy now? However, since the stock price and fair value will rise, it's like buying 2 quarters ahead. You can still profit because of the high growth rate. It's similar to PEG. You shouldn't buy early for companies with low growth rates. So it's good to look at it with those concepts in mind. So the current stock price is here. The value shown here is, how should I put it, a very conservative price. And you should see it that way. I mentioned that this fair value is not a target price, but rather the fair value. So a company can be overvalued or undervalued at any time, which means it can reach the upper limit or the lower limit as well. We try to buy at the bottom and sell at the top as much as possible. So with Credo Technologies and also recently with companies like Nvidia and Astrolabs, there have been some price corrections and movements due to recent issues. That's why we've been focusing a lot on valuation. So I think the Chief Executive Officer has already explained the business model and risks several times through broadcasts, and because of those risks, the stock prices have actually undergone significant corrections. So now we have to determine whether the current corrected price fully reflects those risks. We've reached a price range where that judgment is necessary. So when those videos are uploaded, I think watching them together will help you connect and understand today's lesson much better. So today we covered the basic concept of PEG, and also that you shouldn't just look at PEG for a single year. You should compare around 2 years and observe the changes. Next, when it comes to the proper valuation or fair stock price, you need to multiply it by the future growth rate. You need to project the future and compare it with the current price to make a more reasonable valuation. I think that's how I can summarize it for you.
I think today's lecture was also very high level. If you could also predict the future stock price trends in advance, I think it would be extremely helpful. And changing that line from a step shape to a curve also makes a huge difference in understanding valuation right now. So I'm personally really looking forward to that upgrade. That's right. And for those of you watching the broadcast, you might have some questions. So let me share my personal opinion. The Chief Executive Officer said that for some stocks, it's right to use PER for valuation, and for others, it's better to use price to sales. I've actually been using the same approach for a long time. I once made a video about the expected stock price 5 years after 2020, and at that time, I also mainly used price to sales ratio for growth stocks. So let me briefly explain why I prefer price to sales ratio when evaluating growth stocks. What we call PER, the E, stands for earnings, which is net profit. But in accounting, net profit can be adjusted significantly depending on the management's intentions. The reason for this is because, first of all, labor costs are included, then sales and marketing expenses take up a large portion, and also R&D costs are included as expenses. When calculating net profit, all of these are subtracted from revenue. But as we can easily imagine, marketing expenses, sales expenses, labor costs, and R&D expenses can be increased or decreased significantly depending on the will of the management. That's why when measuring a company's valuation based on PR, what about growth stocks? Some companies invest heavily in R&D or sales and marketing, while others are very conservative and manage their costs well in those areas. Naturally, the PER of these two types of companies can be vastly different. So personally, I think companies that work hard on growth, like Credo, and also put a lot of effort into R&D and sales marketing activities, are actually better companies. But because of that, the PER can actually be higher rather than the PER. When evaluating growth stocks like these, I wanted to give you a tip that it can be helpful to pay more attention to the price to sales ratio when measuring valuation. Is that all you prepared for today? Thank you. Yes.
Elementary school keeps getting longer, and even today felt long. Sometimes I wonder if this is really elementary school material.
I actually felt the same way, but the viewers level keeps getting higher, so I think they'll be able to handle it well. Like Chief Executive Officer mentioned earlier, it feels like the Mijun broadcast is finally becoming a complete entity. When I interpret and deliver the issues or problems in the existing news in my own way, the Chief Executive Officer then explains them again through numerical analysis. Asara Labs is one example. So for those who watch this broadcast again and also watch Chief Executive Officer Kim In-jong's lectures, in a way, it seems like a path is opening up for your stock investment experience and skills to improve very quickly. Thank you. We'll wrap up here for today. Since we now start the broadcast earlier, Chief Executive Officer NIM seems a bit more energetic than before.
He seems less tired, right?
His voice still has energy, and so does mine. I think it's a positive change. Moving to Malaysia was a good decision.
Then
It's a bit disappointing today, but we'll say goodbye here. We'll see you again next week on my YouTube broadcast. Thank you for your hard work today as well, yes.
you worked hard too, Chief Executive Officer.
Thank you, yes.
Thank you, thank you.